Over the last 2 decades or so, even more, maybe 3 decades, there has been one very constant theme in the investment world, and that is declining interest rates. They peaked in 1980 in the high teens, and they've come crashing down to what we thought was a low in 2008, but an even lower low now, today, in 2021. And it's presented this dilemma for a lot of people who are older and are trying to be income investors. There are two main types of investment strategies out there. You can be a growth investor or an income investor. And when you're an income investor, you're expecting to get paid an interest rate or a dividend. And because those rates are so low, it's made that type of investing very difficult. So if you're older and you're trying to be an income investor, you have to be creative. You've got to find ways to create income without taking on too much risk. A CD in the bank pays under 1%. I don't even really consider that an investment. It's FDIC insured, of course. One of the key features of income investing that a lot of people miss is how interest rates and dividends work, because you get paid per share. When we express it as a percentage, it's really just for convenience. And that's how we're normally used to thinking about interest on our checking accounts, right? If you have $100,000 in a checking account and it's paying 1%, that's $1,000 a year. If you reduce the account balance to $90,000, 1% of that is $900 a year. So if your balance goes down, the interest payment goes down. But that's not necessarily how it works with investments in stocks and bonds that pay interest and dividends. If the value goes down, the market value, your interest payments don't change. They continue to be the same. If you had 100 shares in some dividend-paying stock and they were paying you $1 a share, if the stock price goes down 20%, they're still paying you $1 a share. So your interest payments and dividends don't change. They're a lot like rents on an apartment building. If the value of your rental unit or apartment goes down, you don't collect less rents. You could, I guess, in theory, but it's not a necessity. One common feature with income investing is that the higher the yield, the more volatile the portfolio will be. So if you're trying to increase the income on your portfolio, be careful, because you can also take on a lot more risk doing that. I would argue it's almost imperative that you have to take on more risk if you want the income to increase. So be sure to work with a financial professional and determine what your risk tolerance is for taking on these types of investments.